Jyotivardhan Jaipuria, who's joining us on the show from Valentis Advisors. Jyoti, good to have you on the show. Let's begin by discussing the market itself. Seems like there's no fresh trigger for the market. The earnings are done with, the Fed trajectory we pretty much know, the war is playing out per script, and state elections too is something which seems to be factored in for now. What do you think could be the next trigger point for the market or the next key monitorable to watch out for?
Yeah, so like our view, and even on a couple of earlier shows I came, our view has been like market is going to be range bound. Essentially, valuations are not on the cheap side; they're probably higher than fair value, and to that extent, probably what we'll have is earnings continue to be very good, but market being range bound, it just helps valuations come back to little more fair value levels. Short term, I think there are a couple of things to just think about. So one is, earnings season is over, like you said, it has been good, and probably we've seen some upgrades along the way. But as we get into election season, people are watching for the assembly election results and what they'll be. So one thing which I'll highlight is we've done an analysis of a lot of assembly elections over the last 10 years, and the impact on the markets have been, negligible. It never really changed the direction of the market. The second is, people are thinking this is going to give an indication of what happens in the elections for next year in May of 2024. But again, we've done an analysis of the last 6 assembly elections which happened in these states. And what happened in the final Lok Sabha elections were totally different from what happened in these assembly elections. So I don't think they'll give an indication at all. The only thing with elections I'll highlight is if you had bought 6 months before elections in the last 9 elections, and you sold like on the day before the election results came out, you made money in 8 of the 9 elections, and you basically made an average return of 14%. So basically, the historic trend is there's a pre-election rally which happens in the market, and so maybe we'll see that playing out again this time also. That's one thing you have to remember on elections. The other thing is just we're getting into December, which has generally been a good month for markets in general. There's a Santa Claus rally which plays out. So we could see something like that play out. But typically when that plays out, we have a weak Jan and Feb. So our view still is on an overall basis, you're probably in a range bound sort of market. And it will be good for market if it's range bound because this helps valuations become a little better.
Sure, point taken, and elections is one of those things to watch out for. But I'm very intrigued, Jyoti, to look at the entire banking sector. Massive underperformance at the time when this seems to be a consensus buy. You ask any fund manager, any analyst on the street, they are overweight on financials. What then explains this underperformance?
Yeah, Manisha. So, whenever there's consensus on something, it's always one of the most dangerous sectors to go into. In fact, we run this theme which we call the 3 U's. So, one of the 3 U's is like under ownership, and we like under ownership. Whenever there's consensus buy, there's over ownership, we always like very skeptical about it. But I think there are 2, 3 things which are going for the bank sector. One is what we have to remember is last year was a great year for banking sector. So all the stocks did very well, and most of the stocks have seen a 40-50% increase. Second is fundamentally what happens is whenever interest rates start to move up, the first phase you have a big spike in net interest margins because the deposits don't reprice, whether the loans reprice immediately. In the second year, what happens is the reverse happens. The deposits start to reprice, and the loans have already repriced, so you have the net interest margin starting to get squeezed. And that is what we are starting to see just now. Over the last couple of quarters, most banks have shown NIM, which is like come down 30, 40, 50 basis point. So you're seeing the impact of that. Third is obviously, the RBI has been very, very cautious and highlighting that we want unsecured loans to go slow. We want banks to be more careful because we don't want a repeat of, another NPL cycle. So to that extent, there's some cautiousness. We have frankly, like given the weakness in the banks, we are actually looking to add position in the banks now. Because for us, it is, some of these weaknesses and it may persist for the next few weeks, but that's one we really want to buy some of these things because there are banks, especially, some of the smaller public private sector banks are looking very cheap, and I think they will do well over the next 12, 18 months. So for us, it is some of these will be opportunity to buy really.
Okay, so this is an opportunity to perhaps buy the quality banking names that you've always been waiting for. But, Jyoti, since you're looking at for those anti-consensus ideas and somewhere where the ownership is actually on the lower side, which are those themes and areas? Because whether I look at a defense or a industrials or a capex or manufacturing consumption, all of this seems to be a very discovered story. What really is then left now in the under ownership basket? IT?
Yes, Manisha, it is one of them, and the other was pharma. So, over the last 6 months, pharma has been one trade which we've done and which we've actually bought and has done well for us because pharma was classic. Nobody liked it. We took a call early part of this year saying that the US generic story will finally play out because that's something where, for the last 5, 6 years, US generic prices were under pressure and most of these companies were doing very poorly. Our call was that the US generic price pressure has bottomed out, and to that extent, we'll probably start seeing better numbers from these companies. It was a call which played out early, and what we've heard from a lot of the managements over the last 3 months have reinforced our call because now most of them seem to be coming to our view. So that's one segment where things had done badly for the last 18 months in terms of the stock price. Earnings were not that great, but earnings will turn around, and that's one segment which you're playing. IT, like you said, it's there. It's coming on our horizon after a long time because we've been underweight on this for quite some time. Like we used to say, buy local, avoid global. I still think there's a couple of quarters of pain. So for that is we want to buy bad news. So if we get bad news on numbers, we get companies sounding very cautious. We want to buy that bad news because things are getting, in our CUs, is starting to get undervalued. It's not yet undervalued really, but it's underperformed for sure and is starting to get underowned now. So IT is on our horizon, not really bought it in a big way, but pharma is something we've bought in a very decent size.
Pharma is one of the recent sizable allocations and IT is on the radar. But what about the IPOs? You're spoiled for choice when it comes to that. You have the Power Financier, IREDA. You have Tata Tech, which is one which has got a lot of interest. It's already subscribed 3x within just 3 hours of opening for subscription. And then, of course, there is Flair Pens, Fed Bank, and the others as well. Is there anything that interests you from this pack?
So, just from the IPO pack, what happens is we don't get allocation. So, since technically, though we are the PMS is not treated as a QIB, we don't really get allocation, and that's where we always have a problem with IPOs. Once it opens, we may be looking at some of these names, like some of these tech names look good. But in general, what we find is most of the IPOs are priced higher than what corresponding companies in the secondary market are listed. So a lot of the returns are made upfront, and beyond that, you tend to see a lot of these IPO prices. Once they get listed, then they don't go anywhere. So that's why we end up not really participating too much in these IPOs.
Okay, Jyoti, on that note, we let you go. Appreciate you making time and speaking with ET now. So that's the latest coming in.